This is Real Estate This Week with Stephen Gasque, continuing 16 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and I'm so glad you're here as we tackle a really important question. What's the one thing that can mean you get the house or you don't? And if you do get the place, one thing that can mean you either have the lowest monthly mortgage payments or the highest. The answer, of course, is your credit. It's so important to every buyer, every seller, and every homeowner. So let's talk about how you can take bad credit and make it better. Or if you already have great credit, how to keep it there. Joining us now is Gerri Detweiler, the leading source for credit information in America. Gerri, welcome to Real Estate This Week.
Thank you.
I am so glad you're here because we need some good advice. As you know, recently mortgage interest rates dropped, and a lot of buyers are trying to get in the game and get a home of their own with a mortgage. But as we both know, there could be a barrier, their credit. Tell us about the connection, Gerri, between your credit and your mortgage.
It doesn't matter whether interest rates are going down or going up. If you have good credit, you will probably get a better interest rate. So regardless of what's happening today or tomorrow or yesterday in the mortgage market, you do want to really focus on the things you can control. And one of those things you can control is your credit history. So you want to focus on trying to build strong credit.
I see. And let me ask you this. There's the credit report, which could be 50 pages long. And then there's just the credit score, which is just 3 numbers. What's the difference and why does each matter so much?
The credit report is the data, the information about how we pay our bills, and that's what's used to create credit scores. Now, in the U.S., there's 3 major credit bureaus, Equifax, Experian, and TransUnion. And mortgages are a little bit unique in that the lender will almost always pull credit reports and scores from all 3 credit bureaus. A lot of other lenders, it's just 1 credit bureau, but with mortgages, it's all 3. And they'll typically look at the middle of your 3 credit scores. So when I say to people, hey, you need to check your credit reports with all the major bureaus, you need to see where you stand, I really mean it when it comes to a mortgage. You need to understand where your credit stands with each bureau. They don't share information with each other.
You know, that is so good to hear because I had a question for you on a personal basis is that my banks always monitor my credit and I can go and see where it is. But one bank has it at one level, another bank has it at a lower level. Why?
Typically, there are different credit scores that are used for different purposes. So if you have a credit card with one company and they're checking your credit, for example, with Equifax, they'll probably show you the credit score that they used for that credit check. And it's probably a credit score that's geared toward credit cards. Mortgage credit scores are geared toward getting a mortgage. And so while I don't think you have to know every single credit score that's out there, I do think it's important to look at the underlying information because if your credit report is not accurate or it's not correct, then your credit score won't be correct. And you want you want as correct a credit score as possible when you're going for a large loan like a mortgage.
So, Gerri, when you advise us to go in and look at your credit report, what should we be looking for that could improve the numbers?
Annualcreditreport.com is the website that's mandated under federal law for you to check your credit report for free. It doesn't require free credit scores, though, so you're just going to see the report itself. And the things I would really focus on there is making sure that all the accounts that are listed are yours. Make sure that the information looks relatively accurate. There's going to be about a month reporting cycle, so it could be your balance from a few weeks ago, not your balance, today. And And then if you're thinking about, well, what can I do to improve my credit score, I have two pieces of advice. One is the easiest thing, usually or very often, to affect your credit score is bringing down balances on credit cards because high balances on credit cards can affect your credit scores. But the second piece of advice I have is work with a mortgage professional. So sometimes what we think might, improve our credit score turns out to be something that would not help our credit score. So make sure you're working with someone who understands how these work so you don't inadvertently do something that could bring down your scores.
Excellent. And one thing I'd like to mention, Gerri, is something you've told me many times over the years. And that is, if you are trying to reduce the amount of credit you're using on credit cards, fine, reduce the amount, but don't cancel the card. Now, why is that?
That's correct. And the reason is the credit limit that you have is compared to your balances on individual accounts as well as all of your accounts added together. So when you close out an account, you reduce the available credit, and that may make you look like you're carrying, larger balances compared to your overall credit limits. So that's something I don't recommend you do if you're in the mortgage process. Again, unless your mortgage professional will tell you to do that, don't do it. And the other thing I don't recommend you do if you're hoping to buy a home soon is getting new credit, because new credit can create an inquiry on your credit file that can bring down your score by a few points at least. And then it also creates a new account, which at least for the first couple of months may be a factor that brings down your credit scores a little bit. So if you're thinking, hey, I'm going to buy this house, I'm going to fix up the kitchen or get new appliances or get new furniture, wait until that loan is closed and then you can go shopping, but don't do it before, again, unless your mortgage professional says no problem.
That's great advice, Gerri. And I've got to tell you, it can be really hard because say that you go to completely redo your kitchen and the store says, hey, you can get 15% off the entire purchase if you apply for our credit card and you put the purchase on that. And many people just go for it. Not a great idea, right?
Yeah, I mean, it can be a great idea, but again, after the loan is closed, I did the same thing with a house I bought where I bought a new kitchen, but I didn't do it until that house was in my name and that mortgage loan had been funded. And then I went shopping. So I'd recommend you do the same thing.
I see. Now, Gerri, let's look at the process of getting a mortgage and how your credit score impacts that. So, if I have a really good credit score, I know I'll get the best rate. But tell me, looking at the actual credit score numbers, what is a great credit score and how far does it go? From 850 down to what, 750? What's the range of a great score?
Yeah, most credit scores run in consumer credit scores in the US run on a range of 300 as the lowest score and 850 as a perfect score. And most mortgages, you will be in the higher credit score band or the lowest interest rate if your credit score is usually about 720 to 750, sometimes a little bit higher than that. Once you get into the lower 700s, you're probably still getting a great rate. It may not be the absolute cheapest rate, but it's probably still a very good rate. And then just as you go down, the rates become a little bit higher. Once your credit scores are in the low 600s or high 500s, it's usually called subprime. And that's where you will pay probably quite a bit higher interest rate. But, you can still get into the home, hopefully, with a payment that you can afford. And if that's the case, it may make sense to move forward.
And at what point would a lender say, your credit score is just too low? Forget it. No way.
Well, there are lenders who will work with borrowers of lots of different credit backgrounds, but usually if your credit scores are in the 500s or the low 600s, you're going to have a more difficult time getting approved, and you may need to have a larger down payment, which for some people may be a bit of a hurdle, in this economy. So it really depends. If you have credit challenges and you really have found a house that you want to buy, I would just work with someone who really understands that market and be careful about getting into a loan that's more than you can actually afford. That's, I think, the biggest risk.
That's excellent. Excellent. And so again, looking at the person who wants to buy a house, if they go to check their credit score and it's great, go for it. But if it's really low, how long could it take to fix that credit score?
Improving a credit score really depends on what's bringing it down. So, for example, if you have a credit card that's maxed out, if you pay that card down, maybe pay it off or pay the balance down to, let's say, 10 or 25% of the available credit, you might see your credit score jump by 10, 20 points or even more in the next billing cycle. So there are some things that can be done fairly quickly. The harder things to overcome are things that are recent and very negative. For example, you missed payments last year on multiple credit cards. You have lots of late payments. They're accurate on your credit report. That's going to take a little bit more time to recover from. But one thing I always tell people is time is your friend here. If you are patient and you focus on paying everything on time, as negative information gets older, it does have less impact on your scores.
Oh, that's good to know. Good to know. And what about a technique we've talked about before, in which, say that someone has $30,000 in credit card debt, and they're really having a tough time with that. But then they take out a personal loan for $30,000 and all that credit card debt is paid off. And now they just have this other loan for $30,000, which usually would have a fixed time, like 5 years. What about that, Gerri?
Yeah, replacing a revolving account like a credit card, a balance on a revolving account with an installment account like a personal loan that you mentioned may be beneficial to the credit score because then you aren't maxed out on the revolving line of credit. But I would say two things. And one is, of course, don't close out that credit card. We already talked about that. Leave that open so you still have that credit line available. And the second thing that I would say is that with mortgages, the lender will take a close look at your debt to income ratio. So they will take a look at your monthly payments compared to your income. And with a personal loan, your payments might go up a little bit because you might have, say, 5 years or even 10 years to pay it off. Whereas with a credit card, you could make a minimum payment that could take 30 years to pay off. So there is a balance there that you want to make sure you are aware of and that, again, you discuss with, your mortgage pro so you can make sure that you figure out the strategy that makes the most sense for your situation.
Excellent. And Gerri, earlier we talked about the range of credit scores. So let me ask you two quick questions about that. Have you ever met anyone who has the absolute top credit score of 850?
I have. In fact, I have two friends who recently have texted me with a snapshot of their credit score because they're so excited and proud to have that 850. But I will tell you, I have not. So I have not. I'm good credit, but I'm not perfect.
And what do you do to get an 850? I mean, how perfect can you be?
Well, you don't have to stress about it because you aren't going to get a lot more out of an 850 than you would, say, an 800 or even a 780 credit score. So don't get too stressed if you're not there. But really, the big thing there is a long history of credit, always paid on time, low balances, a good mix of credit. Those are the factors that really contribute to strong credit scores.
I see. And on the other side of the spectrum, Gerri, have you ever met anyone with a 300 credit score, the lowest it can be?
I have not met anyone with a 300, though I've seen people who are what's called credit invisible or unscorable, and so they don't have enough credit to create a credit score. And that's a big problem, actually, in the U.S. There are several million Americans who don't have a credit score, and that can be just as equally challenging as bad credit. The difference with a thin file, they call it, or credit invisible, is that once you get a few references under your belt and some payment history, you'll probably see some improvement pretty quickly.
I see. And another real-world scenario that could affect people trying to buy a house. Students. What if someone has just graduated from college and they don't have much credit at all? They've never had a credit card. They've never had a car loan. What will their credit look like, and how can they build it into really solid credit?
If you don't have a credit history or don't have much of a credit history, then you probably don't have a credit score because credit scores depend on, information about how you've handled your bills in order to predict how you're likely to you are to pay your bills on time in the future. So you probably be unscorable. But here's a tip that can work for someone in that situation as well as someone who might be on the path to rebuilding their credit. And that is a technique that we've talked about before called piggybacking. And this is where a friend or relative who has an impeccable credit history on one of their credit cards, a long history, they don't carry high balances, they add you as an authorized user. And typically, what happens when they do that is that account, the entire history for that account, appears on your credit reports and can contribute to your credit scores. So, that's one technique that might be useful if you know someone that really trusts you and that you can trust to add you just as an authorized user to their account.
Oh, that's really a great idea. I have never heard of that before. Piggybacking your credit. That's a great idea. And another thing I'd like to run by you is that one time I talked to a young person who had just gotten out of college and they were trying to build credit. And they had a good idea that I'd never really thought of. They said, well, I got a credit card and every month I pay my Netflix with it. What do you think?
I think it's a great idea. You don't need to have high balances and you don't have to carry debt to have good credit, but you do need to get a credit card and use it because that activity then shows the credit scoring model, shows the lender that you pay your bills on time. And so that's something that I do recommend. And by only putting a few charges on a credit card, you keep it active, but you don't worry about running up a lot of debt.
I see. And Gerri, what about a car loan? Will that hurt or help your credit score?
Car loans are a type of installment loan that you pay over time, and so they can be very helpful to building a credit history. Again, though, if you're in the mortgage process, don't go out and buy a new car until you talk to your lender and make sure it's okay because new accounts they do tend to show a little bit of risk until there's an established payment history. So you don't want to do that and then next month try to get a mortgage because it potentially could backfire.
I see. And so, Gerri, let me end up with two big questions. First of all, what's the worst thing you can do for your credit in 2025?
The worst thing you can do for your credit in 2025 is not to make your payments on time. I mean, payments are the number one factor in a credit score. And I know a lot of people feel financially stressed. So if possible, at least try to make your minimum payments on all your credit cards, even if you can't pay as much as you'd like. And if you can't make your minimum payments, reach out to a nonprofit credit counseling agency and get some help so you can get back on track.
Excellent. And now looking at the other side of the story, what is the best thing you can do to get your credit score as high as possible in 2025?
The best way to get your credit score as high as possible is to use credit, but use it very carefully. So paying on time, not taking on debt that you can't pay back, but keeping an active credit history is essential to a good credit score. And I have to add a caveat there too. If you aren't paying attention to your credit, then none of this matters. So I highly recommend you at least check your credit report on a monthly basis so you know what information is in there. Fraud is an ongoing problem, and if you don't check it, you may not know what's happening.
Well, Gerri, this has been pure gold because as we know, if you want to get a mortgage, it involves three things: your income, the reserves that you have in the bank, and your credit. And if any of them is out of whack, forget that mortgage, especially your credit. And you have really helped us so much. And I want to thank you for joining us on the show.
My pleasure.
Ours too. Gerri Detweiler, the leading source for credit information in America. Next time on Real Estate This Week, one of the best options for anyone buying a house, but one that many people forget about. Buying a brand new home where there might be less competition, great prices, and even lower mortgage interest rates. That's next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every Thursday. everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.